Welcome back to Investing Talk podcast.
Today, we're looking at Ichor Holdings.
As usual, before we start, subscribe, like, and comment to this video to support the show. It really helps the algorithm find us, and we appreciate every single one of you tuning in.
We have a really fascinating setup today.
Right.
We are looking at a company that just dropped their Q4 2025 earnings, and it is arguably one of the most critical players in the entire semiconductor supply chain.
But nobody's heard of them.
Exactly. Most people have never heard of them because they operate in the background. They handled the specialized plumbing of the chip world.
Okay, hold on. Before we get into the plumbing, which I admit sounds a little less than glamorous, I need you to explain a paradox to me.
Go for it.
I'm looking at the chart for Ichor ticker ICHR, and I see a stock that just smashed through a 52-week high. I mean, it is absolutely ripping.
It is.
But then I look at the headline numbers, and revenue is actually down over the last 3 years, and their return on equity is negative. So, to the untrained eye, this looks like a company losing money that is somehow trading at all-time highs.
Right.
Are we looking at a bubble, or am I missing the secret sauce here?
You are looking at the rearview mirror, but the market is pricing the windshield. That's the disconnect.
Okay.
Yes, the historical numbers show the brutal cyclical downturn the chip industry just went through. But the Q4 report and, more importantly, the guidance are flashing a massive go signal for 2026.
So it's not a bubble.
This isn't a bubble. It's the beginning of a new cycle.
All right, so the train hasn't left the station.
The train is just leaving the platform, and the engine is upgrading as we speak.
Okay, I like the sound of that. Let's get into the nuts and bolts, or I guess the valves and pipes of what they actually do. You called it plumbing, but I assume we aren't talking about fixing a leaky sink here.
No, far from it. Fluid delivery subsystems is the technical term, and it sounds dry, but it's actually terrifyingly complex. Think about how a modern microchip is made. You're depositing layers of material that are, only a few atoms thick. To do that, you have to pump very specific gases and chemical vapors into a vacuum chamber.
Right, for things like etching the silicon.
Yeah, exactly.
Yeah.
But these are not friendly gases. We are talking about things like chlorine trifluoride or extremely volatile precursors. Some of these chemicals are so reactive that if they touch moisture in the air, they explode.
Wow.
Others will literally eat through glass or stainless steel if it's not treated properly. Ichor builds the systems, the gas panels, the chemical delivery modules that transport these nasty substances from the tank to the wafer with atomic-level precision.
So it's kind of like building a hazmat suit for the most expensive sand in the world.
That is the perfect analogy, and it has to be unbelievably clean. If a single particle of dust, and I mean microscopic dust, gets into that gas line, it lands on the wafer and ruins a chip that might sell for thousands of dollars.
Or the entire batch.
Or worse, yeah, the entire batch. So Ichor isn't just bending pipes. They are doing proprietary welding, E-beam surface treatments, and assembling everything in these ultra-clean rooms.
Which explains their moat. I was going to ask why a company like Applied Materials or Lam Research doesn't just, buy valves from a generic hardware store.
You don't bargain hunt for parachutes, and you don't bargain hunt for gas lines in a billion-dollar fab. The switching costs here are astronomical.
Right.
Once Ichor's subsystem is designed into a tool, say a new etcher from Lam Research, that design is locked. You aren't going to risk changing the supplier to save, 5% on a valve when a failure could shut down a TSMC factory line for a week.
That reliability is the moat.
That's the moat.
Okay, so they are sticky. They are essential. Now, let's look at the actual performance. You mentioned the windshield view earlier. Break down the Q4 numbers for me, because on paper, they did $223.6 million in revenue.
Right, and if you're a pessimist, you'll point out that $223.6 million is technically a slight dip from the previous quarter.
Which usually sends a stock tanking. Sequential decline are dirty words on Wall Street.
Usually, yes.
Yeah.
But two things happened. First, they beat expectations. The market was bracing for worse. But the real rocket fuel, that was the guidance for Q1 2026.
What did they guide for?
They came out and said, we expect at least $240 million next quarter.
That's a significant jump. That's not just stabilizing. That's growth kicking back in.
It's the inflection point everyone has been waiting for. And the CEO, Philip Burrows, was very specific about why this is happening. He used phrases like technology transitions and advanced architectures.
Translate that from CEO speak for us.
It means the chips are just getting harder and harder to make.
Yeah.
We're moving to gate-all-around transistors. We are seeing high-NA EUV lithography. We are seeing 3D stacking of memory.
Yay.
Every time you add that kind of complexity or you add 3D layers to a chip, you need more deposition steps and more etching steps.
Which means more gas, more plumbing, more Ichor.
Precisely. The intensity of fluid delivery is going up faster than the number of wafers being produced. So even if the chip market grows, say 5%, ICHR might grow 10 or 15% because the density of their equipment inside the tools is increasing.
So they are levered to the complexity of AI chips. That makes a lot of sense. Now, growth is great, but I need to know if they can afford to fund it. I'm looking at the balance sheet, and honestly, it looks like a fortress.
It really is.
I'm seeing a current ratio of 3.08. For those listening, that just means for every dollar of bills they have to pay in the next year, they have $3 of cash or liquid assets sitting there.
It gives them incredible flexibility. And their debt to equity is only 0.24. In a capital-intensive industry like this, being that under-leveraged is a huge advantage.
It means they're not servicing huge debt.
Exactly. That cash can go straight into expanding the business.
But they aren't paying dividends, are they?
No, and you shouldn't want them to, not at this stage of the cycle.
Explain that. Usually investors love a dividend.
Well, if a company pays a dividend, they're essentially saying, we have no better ideas on how to grow your money, so here, you take it back. Ichor's saying the opposite. They're saying, we have massive growth ahead of us.
So they're reinvesting.
They're pouring that cash into facility expansions, specifically in Malaysia and Mexico.
Okay, I want to pin that Malaysia and Mexico point for a second because I think there's a bigger geopolitical story there. But first, margins. Q4 gross margin was 11.7%. That feels kind of thin.
It is thin if you compare it to a software company, sure.
Yeah.
But you have to look at the trend. The trailing 12-month average was under 10%. So jumping to 11.7% is a really strong sign that operational leverage is kicking in.
Operational leverage meaning as they sell more stuff, the fixed costs of running the factory get spread out, so they make more profit on each extra unit.
That's it, exactly. They have these factories ready to go. Running them at 50% capacity is expensive. Running them at 80% capacity, that's a money printing machine. As that revenue climbs from $223 million to $240 million and beyond, those margins should expand pretty rapidly.
Okay, so the fundamentals are turning the corner. But fundamentals can take years to play out. The chart is moving now. Let's pivot and talk about the price action, because this is where my skepticism usually kicks in. Buying at a 52-week high, it just feels like chasing. It feels like FOMO.
It is the hardest psychological hurdle in trading, I think. We are wired to buy low, sell high. So when we see a high, our brain screams too late.
Right.
But in technical analysis, a breakout to a 52-week high is often the safest time to buy.
Because there's no overhead supply, no sellers waiting to get out.
And go. Think about it. If a stock is trading at $30, but it used to be at $40 last year, there are a bunch of people who bought at $35 and $38 who are currently losing money.
They're just waiting to get back to break even to sell.
They are praying for it. That creates selling pressure. But at a 52-week high, everyone is green. Everyone is making money. There are no bag holders waiting to sell. It's what we call blue sky territory. The only pressure is buying pressure.
And looking at the chart, I mean, it wasn't a quiet move. There were gaps.
Huge gaps. The price jumped overnight and opened significantly higher. That tells you that buyers were so desperate to get in, they were willing to pay a premium right at the opening bell.
And that's not retail.
That is rarely retail traders like you and me. That is institutional urgency.
Okay, speaking of institutions, this is the part of the research that actually made me stop and reread the line. I thought it was a typo.
It's not a typo.
The institutional ownership is 97.28%.
It is absolutely wild.
Let's just clarify what this means. Almost 98% of the available shares of this company are sitting in the vaults of BlackRock, Vanguard, and massive hedge funds.
Which leaves essentially crumbs for the rest of the market. The float, the shares actually available to trade daily, is incredibly tiny.
This sounds like a powder keg.
It is. This creates a supply shock scenario. You have all the big players refusing to sell because they see the 2026 growth story. Then you have positive news like this Q4 guidance.
And new buyers rush in.
Suddenly, new buyers rush in. Maybe growth funds, maybe retail, but there is nobody on the other side of the trade. There's no one selling.
So the price has to gap up just to find a seller?
Exactly. It's a classic low-float squeeze dynamic. Even though it's not a short squeeze in the traditional sense, it's a lack of seller squeeze. When 97% of the room is locked, The remaining 3% sets the price.
That explains the volatility. Okay, let's go back to that Malaysia and Mexico expansion you mentioned. Why is a plumbing company building factories in Mexico?
This is the China plus one strategy in action, and it's a massive catalyst. For years, the supply chain was heavily reliant on Asia. But with geopolitical tensions and the logistical nightmares we all saw during COVID,
Customers want resilience.
customers like Applied Materials are demanding it. They want suppliers who are close to home. It's all about near-shoring.
Right.
By building in Mexico, Ichor can truck these systems to the new fabs in Arizona or Texas in a day rather than putting them on a boat from Asia for 3 weeks.
And Malaysia.
Malaysia offers a much lower cost base than their legacy locations.
So it's a double win. Better logistics for the customer, better margins for Ichor.
That's the plan. The CEO explicitly said these new facilities will drive margin gains by mid-2026. This is that operational leverage we talked about earlier. They're moving production to cheaper, more efficient locations right as volume is ramping up.
Okay, so we have the setup. Fundamentals are turning, the chart is breaking out, the smart money owns the whole float, and they have a geopolitical tailwind. It sounds perfect. Almost.
Right.
Too perfect.
You're waiting for the other shoe to drop.
I am. My job is to be the wet blanket here. It can't all be green candles and high fives. We have to execute a dive into the risks because with a setup this explosive, the downside can be just as violent.
Absolutely. And the first risk is printed right on the fact sheet, the beta.
2.07.
That is extremely high.
For those new to the term, beta just measures volatility relative to the market. A beta of 1 means you move with the market. A beta of 2 means if the S&P 500 drops 1%, Ichor tends to drop roughly 2%.
Exactly. This is a high-octane stock. If the market sneezes, Ichor catches pneumonia. If we get a recession scare, or if the whole AI trade unwinds for a bit, this stock will fall twice as fast as the index.
It's not for the faint of heart.
Not at all. Not for money you need next month.
And then there is the cyclicality. We are celebrating a recovery, but we can't ignore that revenue fell almost 12% over the last 3 years.
That is the bullwhip effect. When chip demand softens just a little bit, the chip makers, they stop buying machines. And when they stop buying machines, the machine makers stop buying gas panels.
The pain gets amplified down the chain?
It gets amplified all the way down. Ichor is at the tip of that whip. If this recovery stalls, let's say consumer electronics don't pick up or AI CapEx slows down, Ichor's orders will evaporate very, very quickly.
And we are still looking at a company that is currently unprofitable on a GAAP basis. Return on equity is negative 5.88%.
That's the show me aspect.
Yeah.
The analysts at Oppenheimer who kept their rating at perform, which is basically neutral, this is what they're worried about.
They need to see the proof.
They are saying, okay, the guidance is nice, but show me the profit. Prove that the Mexico factory actually works before I tell my clients to buy.
That's fair. Execution risk is real. Building a factory in a new country isn't easy. So we have high beta, execution risk, and a cyclical history. But we also have a breakout. How do we synthesize this? What is the final verdict?
I think when you weigh the risks against the potential, the setup is still skewed pretty heavily to the upside. The semiconductor cycle is probably the most powerful force in tech right now, and Ichor is the pure infrastructure play on that cycle.
So putting a number on it.
I'm giving this a bullish score of 810.
An 8. That is confident.
It is. The thesis is simple. The cycle has turned. The Q1 guidance of $240 million confirms it. The technical breakout confirms the market agrees. And that 97% institutional ownership puts a huge floor under the stock because the big boys aren't selling yet.
So what's the play for someone listening? Is this a buy and hold forever, or is it more of a trade?
I view this as a prime setup for a swing trade into the Q1 earnings report. That'll drop in late April or early May. The momentum from this breakout should carry us there.
You ride the wave of the positive guidance.
Exactly. And then, if they hit that $240 million number and the margins tick up again, then this converts from a swing trade into a long-term hold for the rest of 2026.
In price targets?
Analysts are looking around $38, and we're closing in on that. If we break through $38, there is really no technical resistance left on the chart at all.
Just remember, folks, a price target is just an educated guess. But with the supply locked up, it won't take much buying power to push it there.
Just keep your stop losses tight. With a beta of 2, you do not want to get caught sleeping if the macro environment turns ugly.
Good advice. And keep an eye on the calendar. You mentioned a conference coming up.
Yes, the Needham Growth Conference in March. Management will be presenting. That is the next big potential catalyst. If they drop any positive hints about the Mexico expansion or AI demand there, that could be the fuel for the next leg up.
All right, there you have it. Ichor Holdings. It's the plumbing of the AI revolution. High risk, high reward, and mostly owned by the whales.
It's definitely one to watch.
Make sure to subscribe, like, and comment to support the show. Let us know, does that 97% ownership scare you, or does it make you want to jump in? We'll see you in the next one.